Hello my dear students, I am Praveen Bansal, your accountancy coach. Today we are covering class 11th accountancy, chapter 7, depreciation. In the previous parts, we learnt depreciation's meaning. It means loss in the value of any fixed asset. It could be because of many reasons: usage, time, wear and tear, etc. Then we studied few methods of depreciation. One of them was straight line method, and then we discussed written down value method. And we learned how do we do accounting of that depreciation thing. We learned how do we make machine account or say any fixed asset account. Today, we are going to cover the same accounting but with a new method, and the name of the method is provision for depreciation. And along with this, we would be making an asset disposal account. What is provision for depreciation and what is asset disposal? When I talk about provision for depreciation, this means earlier we were charging depreciation in the machine account, in the asset account. But now we will be charging the depreciation in a separate account which is known as provision for depreciation account. That means depreciation would be charged in the books of accounts, but it is not going to reduce the value of machine. It is not going to reduce the value of machine. Depreciation would be charged in a separate account, that is provision for depreciation account. But when the machine or any fixed asset would be sold, that depreciation would be transferred to the machine at the time of sale. I repeat, when the machine or the fixed asset would be sold, the depreciation charged till the date accumulated in the provision for depreciation account would be transferred to the machine account and the machine would be sold. That is the meaning of provision. When we make asset disposal account as well, that means at the time of sale, the asset which is meant for sale, I repeat, at the time of sale, the asset which is going to be sold would be sent to the disposal account, and the same machine's depreciation would also be sent in the account. And this is how we make these accounts. Let us understand this concept by an example from your own textbook. On 1st January 2001, Jain & Sons purchased a second-hand plant costing rupees 2 lakh and spent rupees 10,000 on its overhauling, and also spent 5,000 on transportation and installation. Before starting the accounting for depreciation, I would like to recall that whenever a firm purchases a second-hand machine and spends something on its installation or say any kind of expense to put it on use, all those expenses are added to that machine. Installation, transportation, etc. Whatever expenses are incurred, these all expenses are meant for putting the asset into use. So all these expenses are of capital nature. So these are going to add to the cost of machine. Like in the question, we have spent rupees 2 lakh for machine, then 10,000 and 15,000 on transportation and installation. So these are 2 lakh 10 plus 5, 2 lakh and 15,000. So combinedly, the machine is costing rupees 2 lakh 15,000 to the firm. Now, it was decided to provide for depreciation 20% on written down value. Here, the method of depreciation is written down value method. So, before starting this, I would like to give you a quick recap of the methods of depreciation. What is written down value and what is straight line method. Assume you have a machine of rupees 10,000 and 10% depreciation is to be charged. It makes it 1,000 for the first year, and for second year it is again going to be 10% of 10,000, that is 1,000. This is your straight line method. Clear, students? That means year by year the amount of depreciation remains same when it comes to straight line method. But when we talk about written down value method, in the first year 10% of 10,000 is 1,000, but in the second year reduced value is 9,000. 10,000 minus 1,000 makes it 9,000. That means 10% of 9,000 is 900. This is the amount of depreciation for the second year. Year by year, the value of machine is getting reduced, and that reduced value is used to calculate depreciation. For an example, if I say depreciation for the third year would be 9,000 minus 900, that is 8,100, and 10% of that 8,100 is going to be 810. This is written down value method, and straight line was straight, 1,000 flat for year, then next year, then next year. This was the method of straight line, but in this question we are going to treat written down value method. This was the quick recap for the methods of depreciation. Let's get back to the question. As you saw, that machine is purchased on 1st January 2001, and now the question says the plant was destroyed by fire on 31st July 2004. The plant was destroyed on 31st July 2004. That means after 2001, 2, 3 and 6 months of 2004 as well. After 3.5 years, the machine met with an accident, and insurance company gave you rupees 50,000 as the insurance claim. See, students, when insurance company pay you some claim or you sell the machine, it means same. You just sold it, that is it, and admitted by the insurance company. Prepare plant account, accumulated depreciation account and plant disposal account. As I discussed in the starting of the lecture, that we are going to learn what is accumulated depreciation and asset disposal account. We are going to treat this thing today in this question. So students, focus. We are going to make plant account first, plant and machine account. We bought it for rupees 2 lakh and 15,000 is the direct expense attached to that. 2,15,000 is added in the machine plant account. All the assets increases from debit side. That's why it is appearing on the debit side of plant account. If I see the journal entry to buy plant, that is plant account debit to bank, 215,000, and we are doing nothing but ledger. Plant account is debited, and here we have debited the plant account by writing bank account. Is it clear, students? As the question is saying, we have to make accumulated depreciation account. Accumulated depreciation, that means depreciation is to be accumulated. It is not to be charged in the machine account, in the plant account. Depreciation is to be accumulated in a separate account. It is not to be charged in the plant account. That is how this accounting treatment is different from the earlier one. Depreciation is not going to be charged in the machine account. Firstly, I must show you the entry. Depreciation is going to be debited. Earlier, we were making machine account credit, but this time we are not crediting machine, we are crediting accumulated depreciation account. Machine is not getting credited, accumulated depreciation is getting credited like this. One more ledger, accumulated depreciation account, and depreciation is written here, 2,15,000, 20% makes it 43,000, which you can easily see in your working note. 20% of 215,000 is 43,000, and depreciation is accumulated in a separate account, unlike the earlier method. Okay, now whatever the balance in the machine is going to be constant until the machine is sold. I repeat, the balance of machine is going to remain constant until the machine is sold. So, as you see, the year is starting from 1st January, so the financial year comes to an end on 31st December. So, whatever the CD is, the same is BD, and same happens to accumulated depreciation account. As the name is suggesting, accumulated, we have to collect the depreciation till the date of sale of machine in a separate account. So, this is depreciation for the first year, this is the CD thing on 31st December, then it becomes BD of 1st January 2002. Now, here you all need to focus how the depreciation would be charged in the second year. Why we need special attention for the second year? So, students, the answer is because the method is written down value method. The method is written down value method. That means reduced value is going to be treated for depreciation. How? Let me show you. As you know, the machine was for 215,000. In the first year, it got reduced by 20%, that is 43,000. Now, the reduced value is 172,000. Written down value method says the reduced amount of machine is going to be treated as the amount for calculating depreciation. So, 20% of 172,000 is 34,400. This is going to be second year depreciation. Is it clear, students? So, here I charge my depreciation 34,400. Now, this would be accumulated and it would make it 77,400. This is the total amount of depreciation for 2 years on the machine bought on 1st January of the previous year. And as I said, the balance of machine is not going to be changed until the machine is sold. Whatever the cost of machine is, 215,000, it is going to remain same till the time of sale. So, CD will make it BD again. Now, we come on the third year of machine, 77,400 on depreciation. So, the reduced value of machine in the second year was 137,600. As you can see, firstly we reduced 215,000 minus 43, that makes it 172. Then 34,400 was a depreciation for the second year, which is reduced and the value becomes 137,600. This is the value of machine after 2 years depreciation, and the method's name is written down value method. So, this is the amount which is going to be depreciated. 20% of this 137,600 makes it 27,520. 20% of 137,600 makes it 27,520 for third year's depreciation, and here we charge it 27,520. This is how we calculate depreciation on the reduced values year by year when we follow written down value method. And now we'll add these two figures, which will give me 1,04,920, and this is the accumulated depreciation for 3 years on the machine bought on 1st January of last to last year on 1st January. Okay, students? And what would I do to the machine account, the plant account? The plant is going to remain like same, 2,15,000. Now the CD of plant would be the BD of plant for January 2004. But the question says on 31st July 2004, this machine met with an accident and insurance company paid 50,000 to us for the same. On 31st July, that means year 2004, 31st July means January, February, March, April, May, June and July. After 7 months, this machine met with an accident and we gave it to the insurance company, which gave 50,000 to us. So students, on 31st January, this machine is leaving our premises. And for this thing, we have to prepare an asset disposal account. As the name is suggesting, asset disposal account. What is that? Asset disposal means where we can dispose our asset. Dispose means it is going to be zero from our books. The asset is going to be dumped. So whenever we are going to maintain an asset disposal account, we are going to dump this accidental part or the sold part. In this question, we are dumping the whole plant, but it could be a case we dump like half of the machine or say 1/3 or 1/4 of the machine. But in this question, we are dumping the whole plant. The whole plant is 2,15,000. So on 31st July, see, on the credit side of plant, what we have written, plant disposal, 215,000 is gone. Where? To the plant disposal account. From the credit of plant to the debit of plant disposal. To the debit of plant disposal, 215,000. Now, we have to bring this plant to its original value. What is the original value? The book value. What does this cost today? As you can see, 3.5 years have passed. 3.5 years have passed and this plant had been used over the year. So what do? We have to get it on its original value. So what is the original value? The original value is after depreciations. And what are we doing so far? We are charging all the depreciations in a separate account. What is that separate account? The separate account was accumulated depreciation account. And we have charged 1,04,920 rupees depreciation by 1st January 2004. Right? And the machine is sold on 31st July 2004. That means 7 months depreciation is still to be charged. Let us calculate that. The plant is reduced to 1,10,080. The plant is reduced to 1,10,080. And now depreciation is to be charged on this reduced value. Clear? Let me show you the working. 1,10,080 is a reduced value after 3 years, right? So 1,10,080, 20% for 7 months, that is from January to July. It makes it 12,843. What is this? This is depreciation for 7 months. Why do we charge it for 7 months? Because the machine is destroyed on 31st July. That means January to end of July. That is why it is 7 months. Now I am going to charge this 12,843 to the accumulated depreciation account. And when I add these two figures, it gives me 1,17,763. It is to be transferred to the asset disposal account to bring that disposed machine to the right value. Okay, students? So, when this 215,000 thing is reduced to 97,237. What is this 97,237? The reduced value in the end of third year was 1,10,080 rupees. Then 12,843 rupees depreciation is charged for the 7 months. Now the reduced value is 97,237 and you sold it for 50,000 and the remaining figure of 47,237 is your loss. So, here I show it in the asset disposal account. You sold it for 50,000 and this is your loss. And this is how these three accounts come to an end. And the treatment of accumulated depreciation, disposal account and the primary thing, asset account, come to an end. So, you all students are advised to practice similar kind of questions given in your textbook. This is such an important and interesting topic for you. So that is it from my side for this lecture. Thank you.